A black swan is an unexpected, out-of-the-ordinary occurrence with far-reaching consequences. Their rarity, severity, and extensive effect define them. Author, university professor of finance, and one-time Wall Street trader Nicholas Nassim Taleb is credited with coining the phrase. It was in 2001 that the concept was first put forth, but it wasn't until Nassim Taleb published his book The Black Swan: The Impact of the Highly Improbable on Our Lives in 2007 that anyone paid any attention to it until just before the 2008 financial crisis. Because of their rarity and potentially catastrophic outcomes, he hoped to convey the idea that black swan events are impossible to foresee. One must always prepare as if this is a possibility. And then the question arises, where did this idea come from? Since white swans are the norm, a black swan is a rarity. The term, black swan, was coined by Roman satirist Juvenal to denote an event so unlikely that it defies logic. Until one day before 1697, it was really thought that they don't exist. Because only white swans had ever been seen in the West. Their color was universally accepted as the norm. Before the Dutch explorer William Development arrived in Australia, swans had never been seen with such dark coloration. In a reversal of the original story's premise, Taleb argued that the relevance of the story lies not in the discovery of the first black swan, though that was certainly a pleasant surprise for some birdwatchers. This highlights the limitations of learning based on observation or experience alone, as well as the precarious nature of our knowledge. A generalization based on millennia of corroborated sightings of millions of white swans can be disproved by a single observation. According to Taleb, the fundamental black swan problem is how we can foresee the future given our knowledge of the past, and the black swan is a metaphor for this idea. The lesson underlying the black swan is that some things we assume will most likely not happen can actually happen. The question is how to generalize from our particular experiences in a situation when we haven't seen everything there is. Nassim described 3 characteristics of the black swan. First, their occurrence is statistically extremely unlikely relative to the norm. Second, the effects are magnified greatly when they do happen. Lastly, we usually see logical justifications for things after the fact. What we call retrospective predictability in the jargon. It is possible to use all of your knowledge and expertise to prepare for what you assume will happen, but be proven incorrect by a single black swan occurrence, as the black swan theory proposes. This is only one example. Among the countless black swans that have occurred over the years, consider the following. The 2008 financial crisis, which included the collapse of the U.S. housing market, is one of the most recent and widely publicized examples. The ripples reverberated all around the globe, but only a select few had any inkling that they were coming. The 2008 financial crisis was widely regarded by experts as the biggest economic collapse since the Great Depression in the 1920s. Its root cause was the loosening of controls on the banking sector. Because of this development, financial institutions could now engage in derivatives trading with hedge funds. As a result, banks pushed for more mortgages to back the lucrative sale of these derivatives. Since 2007, when supply began to surpass demand, housing prices have been decreasing, trapping homeowners who can't afford the payments but can't sell their homes. The Great Recession can be traced back to the financial crisis caused by the collapse of derivatives values, which caused banks to stop lending to one another. In the same year, Zimbabwe saw the worst case of hyperinflation ever recorded, with prices rising at an almost unimaginably high rate of inflation that may rapidly destroy a nation's economy. Since the annual inflation rate in the country hit 47% in 1998 and continued to trend upward until hyperinflation set in at the end of this period in 2007, the economic system in the country had been in peril for quite some time. As the Zimbabwean dollar's value plummeted, it was replaced by a number of different foreign currencies. The infamous dot-com bubble burst of 2001 followed a period of roaring prosperity and personal wealth creation in the United States. In the years leading up to the bubble's bursting, record low loan rates, widespread internet use, and investor interest in technology businesses all combined to make it easy for startups with no track record to raise large amounts of funding. Asset prices increased, but financing was scarce. Many of these companies didn't even have a viable business model or offering, and their failure contributed to the market meltdown. Currency devaluations across Asia contributed to the region's financial meltdown that year. Because of insufficient foreign exchange reserves, this began after the government removed the dollar peg from the currency. Consequently, the Thai baht and other Asian currencies experienced a precipitous decline almost immediately as capital fled the region. The pandemic of swine flu known as COVID-19 is one possible instance in point. However, in interviews given before the pandemic reached its peak in March of 2020, Taleb did not mention that it could have been avoided. This author finds it problematic to treat COVID as a black swan event, given that we have been repeatedly cautioned to be ready for just such a disaster. As far as he's concerned, the pandemic is a gray swan event, something that will happen inevitability. Black swans include a wide variety of other events, such as the 2 world wars and September 11th. As we have gained some insight into the black swan, we must ask, how can we best take use of this phenomenon? By acknowledging that black swan events will occur and gaining an understanding of the market. Investors can profit from these occurrences and protect their portfolios from incurring catastrophic losses. You'll come to accept the reality of black swan incidents. To make the most of the opportunities given by a stock market crash or a sudden drop in share price, you should eliminate the element of surprise from your response. Perhaps now is the moment to put money into companies that can weather economic storms. The market can rebound, and when it does, investors who purchased low and diversified can sell high. Those who put all their eggs in one basket are the ones who lose the most when a black swan event occurs. However, by spreading your money around to different investments with different levels of risk, you can lessen the blow of a sudden decline. Avoid putting all your hope in one outcome. Predicting the behavior of financial markets allows us to prepare for the inevitable downturn. Nonetheless, in this case, precision depends as much on chance and gut instinct as it does on expertise and complex modeling. Numerous black swan events exist, which can completely derail even the most elaborate planning. Even if modeling is important, we also need to rely on our gut, keep things simple, and use common sense. The question then becomes, how does one get ready for the unknowable? Black swan investing is about finding stocks or other financial instruments that could deliver huge returns. So it's important to remember that the theory isn't about trying to predict future black swan events, but rather accepting that they will occur and making sure that you are prepared to react to whatever happens. When stock prices fall, an essential feature of any black swan event is its unpredictability, thus the strategy will only pay off if and when a crash actually takes place, which could entail suffering losses for a while before finally cashing in. While this is true, some events can be anticipated. As the name implies, a gray swan is an occurrence that can be predicted with some accuracy. However improbable it may be. Despite their unpredictability, natural calamities are not classified as black swans. Future weather events, earthquakes, tsunamis, and volcanic eruptions are all but guaranteed. When the likelihood of severe events is overestimated, a portfolio is subject to tail risk. When there are multiple feedback loops in a complex system, this can happen. Effective asset allocation is the greatest strategy to ensuring a portfolio can survive over the long term. As an example, a stock price may be deemed to have a very low probability of falling 3 standard deviations below its mean. Due to the unpredictability of the market and the prevalence of black swan events, investors who focus solely on the regions of the market with the highest returns run the risk of having their whole portfolio wiped out by a single major event. Keep in mind that not all black swans are bad, and that profiting from some events might assist to compensate for losses in other areas of a portfolio. Positive black swans are discussed, and Taleb offers advice on how to be prepared for them. The occasional stock market crash or major correction should be expected and accounted for. Thus he recommends having an open mind to all opportunities and seizing any opportunity that could look like one. Buying value companies with a margin of safety can help to eliminate potential downside and take advantage of a bear market, which can be an opportunity for a well-positioned portfolio. Although value stocks may have underperformed over the past decade, they should have less downside in the event of a black swan. Cash is not a desirable component of a portfolio because it yields low returns and loses purchasing power over time. Having cash on hand, however, allows you to take advantage of price drops following a correction. Thanks for viewing, have a wonderful day, and I'll see you in the next one. Black swan occurrences do occur, and the sooner we realize that, the better prepared we shall be for the consequences. However, they are extremely rare and difficult to anticipate.